Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
And one of the bigger, I think, stock news stories today, Kurt Wagner, Bloomberg News, breaking the story that the folks at Meta cutting back some of their spending on the Metaverse in particular by as much as 30%, which is a big number. Because remember, folks, this company pivoted hard to the Metaverse several years ago to the point where they changed their name from Facebook to Metaverse. This was a big pivot for Mark Zuckerberg, and now kind of dialing it back a little bit. So we want to get some more reporting on that. We turn to Caroline Hyde. She joins us here in studio, Bloomberg Tech co-anchor. So this is a kind of a big move, I think, for Mr. Zuckerberg. Don't you, Caroline?
It's a signal. And what's interesting about it is, as usual, as they think about the budget for 2026, they're going to make layoffs. They're going to cut about 10% across the entire business.
Okay.
That tends to be what happens at this time of year. But he gathered his top executives in his house in Hawaii to discuss, okay, where should most of the resources be coming from? Because remember, they're spending a ton on AI and people have been worried about that. How can he offset that? Well, 30%. More cuts, therefore, going to this particular part of Reality Labs. Now, Reality Labs are still going to be making your Ray-Ban Meta glasses. They've seen real interest in the AI use in augmented reality. But virtual reality, we're not living in it yet. He really thought we'd all be doing our workouts there, we'd be working there, and it just hasn't caught on in the way that was expected. So, of course, pull out resources from there, reallocate them. And I do think that it's interesting, of course, they rebranded under this name. For now, it's becoming sort of a metaverse of AI and augmented reality rather than virtual reality right here, right now.
So was Meta just too early? Are we not ready yet for a virtual reality? Or?
I don't think we are.
Okay.
I mean, are you using it?
I'm not.
I mean, my husband loved he got one of the original sort of Oculus versions of the headset. And yeah, he was doing workouts and then he sold it in a garage sale. Because I think, and it got to a point where it's like, what are the applications of this? I love the idea of when I'm working abroad and I need access to lots of screens, but I can't have just lots of screens. It was great to see how that could have been used. But I wasn't going to spend that many thousands on the piece of hardware. They've really got to understand the integration here. That's kind of why it's so interesting. It comes at that time where we also understand Alan Dye from Apple, one of the key interface design team leads, the person who's been behind the iPhone X and behind the operating system, behind the applications of Apple. He's jumping ship to Meta. This is a huge coup. He's going to be thinking about the design of these things in the future.
Well, you bring that up about the Apple thing. That's not the first person we've seen leave the Apple AI story. What is going on there?
Yeah, they've really been shedding people. In many ways, this is tied more back to Johnny Ive's departure back in 2019, and they lost a lot of their design prowess people then. This is also turning of the guard. A lot of these people have been at Apple for a very long time. And we're thinking about Tim Cook himself coming to an age where he might be retiring. Many are wondering how executives shift. But you're right, the real deluge, the real loss has been in the AI area, particularly in the large language model department, where they've just taken so many hits in terms of morale. Because, look, they might even be turning to Google for its large language model rather than building it in-house. And they've been recently losing out or sort of waving goodbye to Gian Andrea. That's the main lead of the AI.
So is that the assumption that they're going to farm their AI out to Google, perhaps? And
that's the perhaps.
And I think, and we'll talk to Anurag Rana in just a moment. He'll say from a stock perspective, that's what investors kind of want.
Yeah.
I mean, why spend $1 gajillion to be just do what you do a search.
And it's been self-limiting for Apple in many ways because they're all about safety on the phone. This is all about edge AI. It's not about, therefore, sending all your data into the cloud and doing enormous amounts of data analysis and therefore feeding it through large language models there. They want to be secure. That means you have to only be able to really do the compute on your own phone. That's very limiting at the moment. So you're just not getting the parameters that you need to have a really effective large language model. So therefore, maybe they do have to shift to a third party, at least while they get their ducks in a row.
So how are we thinking about how Meta is scaling against a lot of its competitors right now as we think about this AI race?
Well, isn't it interesting? It all dovetails together in the same way. For many, Meta is showing that it's putting AI first. And we understand the impact because everyone loves these Ray-Ban Meta glasses. They've been selling very well. We've seen that people have really seen the revenue streams galvanize the advertising offering, the marketeers loving how they've used generative generative AI within the product. We're all getting fed better content, more specific to us. That's going to be the help of generative AI. But are we really downloading Meta AI's own individual AI app? I haven't. I'm using it more in WhatsApp. But then we've also got the EU worrying about how they're fending off competition in WhatsApp, because they're saying, look, ChatGPT, even though you can put your ChatGPT within your Meta WhatsApp at the moment, they're making it too difficult. They don't want that straining their own APIs. They don't want to be basically marketing OpenAI's ChatGPT. They don't want to be marketing Copilot for Microsoft. They want you to use Meta AI. So I think they've still got to show that they're the place that you're going to use large language models. They're the place you're going to come for a chatbot. And I think more broadly, they're the place that all of this ends up working from a capital expenditure perspective. So I think for many over at BI, they love the idea that they're going to maybe use Google's TPUs, because that's a cost saving.
Yep, absolutely. Caroline Hyde, thank you so much for joining us. Caroline Hyde, B-Tech co-anchor along with Ed Ludlow, Bloomberg News. They are on top of everything happening out there in the world of technology in Silicon Valley. We appreciate getting a few minutes of Caroline's time here. Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Piece of news coming out of the tech space is Meta, stepping back a little bit from their investments in the Metaverse. And as Lisa Mateo was just reporting, that's pushing the stock up 4% today. Which is a pretty big move here. The stock's only up about 13% year to date. Let's check in with Anurag Rana. We'll talk about a lot of tech issues out there. Anurag Rana is Senior Technology Analyst for Bloomberg Intelligence out there in Chicago. Anurag, what do you make of this announcement or this report from Bloomberg News? Kurt Wagner's reporting that Meta may cut back investments on its Metaverse by as much as 30%. What do you make of that?
See, when you have to invest billions in the AI side of it, you got to find that money somewhere. I know they have good cash flow, but right now everything is going towards building your AI infrastructure. So I think it makes sense for them to cut in other regions or areas to fund this particular project.
It seems as though investors are clearly celebrating this. I mean, we're seeing it up more than 3.8% right now, and earlier a lot higher. What do you think about next steps from here? I mean, clearly they're trying to redistribute their funds into AI development. What are investors looking for from that?
So the same way they were looking at, Metaverse a few years ago, they want to see an ROI. They will ask, the management team as to, you're investing all these billions to create new data center, super intelligence team. What do I have to see in the terms of the return on the core business? And I think that those questions are not just for Meta, but the entire ecosystem as to what is the net effect addition to your revenue or reduction to your expenses down the road? And I think that is not going to end anytime soon.
All right. So I don't know. I think most shareholders are like, I don't really get the whole Metaverse thing. So to the extent you can scale back investment there and put it anywhere else, that's probably a good thing. Anurag, we also had Salesforce reporting results. Talk to us about that name, because that name's been under pressure. I think maybe potential threats from AI in general.
Yeah, the results did come in, almost in line with how we were looking at it, in terms of that the core business is still struggling. But when it comes to some of their AI products, that is starting to do well. They've gained momentum. But when you look at somebody like a Salesforce, when you have a revenue base of $41 billion, it takes a lot to move the needle. So even though these products are very small and, growing triple digits, but they are not, right there in order to take down what is happening on the core business, which is a decline in seat growth or the less addition of seats because of macro IT spending. And that is probably going to be the story, at least for the near term.
So it seems as though analysts are still generally positive in terms of AI adoption trends when we think about this company, though.
Yes, absolutely. And that's, one of the things we saw really good numbers on both the data cloud side of it and also the Agentforce. But when you look at the stock reaction last night, it was up 5-6%. And finally, people have, when you really scrape the numbers and see that their commercial remaining performance obligations, which is the order book for next quarter, which they expect to grow about 13% in constant currency, 4 percentage point of that is Informatica. So when you strip that out, you will see that particular backlog number goes from 11% this quarter to, let's say, 9 or 10%. So the core is still declining, or the core is still under pressure.
So the stock down 27% year to date, Anurag, does that reflect the fact that it's just IT budgets are tight, or that AI poses an existential threat to certain providers like a Salesforce?
I don't think that's the case, because it's going to be very difficult for an established Fortune 2000 company to get rid of their core system of record, whether that's an HR, sales, customer service, and just deploy a model in there. At least we are not there yet. Maybe, 5 years down the road, we may see a scenario like this, but that's not really why Salesforce is struggling. It is basically they are the largest provider of sales automation tool and customer service tool to Fortune 2000 companies. It's those companies that are not hiring at that same rate that they used to, because outside of AI and AI infrastructure, everything else is still weak at this point.
All right, Anurag, good stuff. As always, Anurag Rana, he is our senior technology analyst, Bloomberg Intelligence from the burgeoning tech hub of Chicago, Illinois. We appreciate getting a few minutes of your time. Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Dick's Sporting Goods reported some numbers here. The stock's off about 1%. But boy, they put up some, I thought they were some pretty decent numbers, but what do I know about this stuff? Lindsay Dutch, consumer hardline senior analyst. She's the expert, and she's a Bloomberg Intelligence. She joins us here. Lindsay, talk to us about Dick's Sporting Goods. What did you learn with their earnings release?
Positive. I think that there's, continued strength in the legacy business, and sometimes that's being overshadowed by their Foot Locker acquisition, which closed in early September. But there's certainly pressure on this retailer to execute a very quick turnaround at Foot Locker, and they are already planning to aggressively offload some stale inventory and close some stores. And we even saw some of that changes already over the Black Friday and Cyber Monday shopping weekend.
What's really been the focus there with Foot Locker? What have been the issues at play?
So Foot Locker is a little bit of a different animal for Dick's. They have a lifestyle focus. They also have to be more on trend with their assortment, and they really have to carry sort of the top of the line items, across a variety of brands. Running shoes have been in lately. Dick's does have expertise sort of in that more sports focused arena. And so, Dick's is looking to bring its strong partnerships with a Nike, for example, and other brands like that to elevate the assortment, which should help. They're also looking to bring in more apparel to the stores, and I saw that when I was out on Black Friday. My Foot Locker had a lot more apparel this year. They also had lots of other brands that were being highlighted: Crocs, Timberland. So doing a lot more than just Nike.
Dick's calls the World Cup, quote, the biggest sports moment the U.S. has ever had. What are they telling us about the World Cup and maybe how it might impact their company?
Yeah, so they mentioned that at the Morgan Stanley conference yesterday. All of these sports moments have been really big for their legacy business. People are really leaning into sport. They saw over the shopping weekend, interest in their products that were marketed for the World Cup, and that could be a key event to drive sales going forward. But they touch lots of aspects of sport. Their golf business is doing excellent this year. They also do very well in just team sports when you think about getting your NFL gear for your favorite teams and things like that. They're really seeing success across the board, but those big events just give them an opportunity to advertise and bring people into their store.
Who are their main competitors right now? Who do you see within this landscape?
Yeah, so that's a very difficult question, given that I think that they've done a really good job sort of breaking out of lifestyle and really focused on athletes. And that's what makes them different than a Foot Locker, than a JD Sport. I think one of their closer competitors could be Academy Sports and Outdoors. They're much smaller in size, but that retailer, Academy, does compete with Dick's and is looking to more focus on athlete and bringing sort of that athletic assortment to their customer as well.
Lindsay, what is Dick's telling you? What are some of the other consumer hardlines companies telling you about the consumer right now?
So Dick's is also unique in that they typically cater to a higher income consumer. So, they have seen resilient demand. They have seen both ticket and transactions continue to rise, which is rather unique. A lot of other retailers are only seeing the transaction front rather than the ticket front. So it tells me that the demand from that higher income consumer, is steady to strong. We do also see that demand for new product that's being rolled out, people are willing to pay a high price point for that. We also see that in footwear, right? Like On has a very high price point. They haven't discounted. Dick's is also not discounting on those premium products. And so that consumer is willing to splurge on those items. There is a little bit more pressure on the lower income consumer this year. I think that affects Foot Locker a little bit more. But the way Dick's is approaching sort of the turnaround and offering greater discounts, it might be an opportunity, to continue to cater to that customer this holiday season.
How are you thinking about the discretionary space? I mean, I know Ulta is reporting after the bell today. I assume maybe the beauty space, can we call it discretionary? Some people might call it essential.
Yeah, I would agree. I think, Ulta there are a lot of connections I can draw between Ulta and Dick's. Both of them had, very conservative outlooks for the back half of the year, baking in a lot of uncertainty about, where demand would go. So Ulta, better than expected results in the first half, very similar to Dick's. We get third quarter results later today, but that outlook again is very low. So there's a low bar for them to hit, at least on the top line. And they're coming off a 2-year best same-store sales comp of almost 7% growth in the second quarter. So I'm optimistic for some strong top-line numbers there, but I do think the number to watch for Ulta today is going to be on the profit line. They already have some pressure on profit with reinvesting in the business, and we've seen some of the retailer stocks, even if the quarter was good, if that profit line is missing, investors aren't really liking that.
Lindsay, we're not hearing a whole lot about tariffs this quarter. What are your companies saying?
So most of my companies have low direct exposure, meaning they weren't directly importing a lot of goods. So the direct impact on them is low. They're working with suppliers and raising prices where they need to manage that. The biggest company in my space that's most exposed would be Elf Beauty, so also in the beauty space. 75% of their product, at least their namesake product, is made in China, so highly exposed there to the China tariffs. But we'll have to wait and see because there are some legal action out there, looking to get those costs back on the retailer side. But you're right, earnings calls have sort of left that topic mostly out of the third quarter commentary.
What are the top major trends that you're keeping an eye on as we head into the next year?
So I do think costs in general, still are facing some upward pressure going into next year. And discretionary as a whole, demand has been quite soft since the back half of 22. So, we're looking to see, when is that going to turn? When are we going to see stronger discretionary demand across the board? And that will help a lot of these more secondary retailers in the space. Someone like an Academy who's sort of struggling to see growth, we could see a lot stronger of a year, with a pickup in that discretionary spend.
All right, Lindsay, thanks so much. Appreciate it. Lindsay Dutch, consumer hardlines. She's a senior analyst at Bloomberg Intelligence down there in our Princeton office, talking to us about Dick's Sporting Goods. Had some pretty decent numbers. Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Well, there's a lot going on in the world of media. I mean, we're waiting for a big M&A trade to happen. We've also got a lot of streaming services jockeying for competitive position relative to Netflix. We got AI impacting advertising. A lot going on out there. So let's check in with somebody who does this stuff for a living. Mark Douglas, President and CEO of Mountain. He's zooming in from one of my favorite towns in this country, San Antonio, Texas, home of my former biggest client, Clear Channel Communications. That was a good company back in the day. Mark, how do you think, you talk to a lot of advertisers, you talk to a lot of agencies, you talk to a lot of folks in the media business. How do you think this Warner Brothers Discovery thing is going to go down? Do you think anybody's got the inner track here?
Well, I mean, literal word on the street is Netflix kind of has the inside track, but it's some pretty serious bidders, kind of the Ellison family, who I used to work for Larry Ellison, Netflix. I mean, a lot of people with resources and who seem to have a lot of vision and really are in building mode. So I think it's like exciting times watching this go down.
I mean, as we're thinking about this potential deal, if Netflix were to actually come out on the winning end, what does this mean potentially about antitrust concerns? Have you been hearing any conversation about that?
I don't think so. I mean, there are somewhat around 200 streaming networks, almost all of whom are billion-dollar companies. So I think it's pretty hard even to look at this from an antitrust perspective, even if it's two of the largest. I think the library that, and honestly, some of those companies are hurting. And so, having some consolidation, I think, is a healthy thing. And Warner Brothers Discovery, I think it's just a fantastic asset. I think in terms of acquisitions or mergers in the media space, I think it's kind of being number one on the list. I think the way people are responding to the opportunity is kind of validating that.
Yeah, with Terry Quadra back at Solomon Smith Brothers, Solomon Smith Barney, he was the first one to trade this asset when he represented AOL buying Time Warner back in the day. So this is not the first go around for these Time Warner people.
Yeah, and look at the program they have: Harry Potter, Game of Thrones, White Lotus. I mean, it's in a lot of ways HBO was kind of the original Netflix. It wasn't obviously on the net, but it had like this incredible original content, which it continues to still have, along with just this broad library of content, and we all watched it on cable. Netflix kind of brought that formula to the internet, and obviously it's kind of become this massive company as a result of that. But I think that's why that library of content, that ability to kind of keep doing it. Like, they haven't really lost, meaning Warner Brothers Discovery, they haven't really lost their mojo in terms of creating content like that. And I think Discovery is underappreciated in terms of the value, that it brings. Shark Week and that kind of like documentary style, and they turned kind of showing, and they turned that also into like reality TV with what's the show up in Alaska, the fishing show.
Oh yeah, the crab guys. Yeah, last five.
Yeah, I mean,
deadliest catch.
It's a lot to watch. It's a lot to watch, and I think that's why people want the asset.
I've forgotten about Shark Week.
Yes. Oh no, that's big, huge revenue.
Just imagine any of these players, especially on Netflix, who has the resources to do it, bringing back Game of Thrones, bringing back a lot of this program. I think it's still going to play really, really well, and it might also play really well outside the United States. So where a lot of these companies need to expand to.
So we talked about Netflix. What about Paramount Skydance? How big of a deal could this be for them?
I think it makes a lot of sense. I mean, the Paramount is a good asset. I think this is meaning there's a lot of programming there, and obviously they pick up CBS and things like that. But adding Warner Brothers Discovery, I kind of think puts them in a much stronger position to challenge a Netflix and challenge a Disney. And that may be one of the reasons Netflix is interested, is somewhat as a, kind of to hold their ground, hold their turf, by not allowing someone to put together a library of content that is, potentially as in the range of strength as theirs is. So that, this could be as much of a defensive move as an offensive move. But I think it makes a lot of sense for Paramount. I mean, once they committed to getting Paramount, I think the acquisitions can't stop. They have to kind of double down, and so we'll see how this plays out.
Mark, for 2026 in the streaming business, you mentioned there's a couple hundred streamers out there. Are there too many? Does there need to be consolidation or bundling, or how do you think the streaming landscape is going to evolve next year?
Yeah, I mean, it has to consolidate. I've always thought, kind of one of the things I've always said on this topic is we could play a game. If I name a streaming network and you can't tell me immediately while you will watch it, then it probably should not exist as an independent network. And we played that game. If I say Discovery, you would say documentary. If I say Netflix, you would say, new shows every Tuesday, and there'd be a range of things you want to watch. If I say ESPN, you'd say sports. And so, when you get into some of the names, you can't as clearly say that, then I think there has to be a consolidation, both in terms of the health of those businesses as well as just what consumers are willing to spend and tolerate. We've gotten to this point where pretty much, we went back to the future in terms of ad-supported content. At this point, I think every streaming network except for Apple TV Plus now has ads. So you can do an ad model and do well. You're not as reliant on subscriptions, but you still have to have a reason for people to come and watch you, and that's the key.
What are your major themes for 2026 as you're looking at the media landscape?
This is the year where it's kind of the official death of cable in a sense. Obviously it's a legacy business, but there's nothing like live sports is moving on the streaming as fast as it possibly can. It's the topic of the day. It's what everyone wants. I think Netflix continues to expand in terms of their ad-supported business, which is great for advertisers and great for consumers. But it's kind of that all content consumption is streaming. I think with the live sports in particular.
Yep.
And one of the things that's been interesting about streaming is you can turn content that's not the NBA and not the NFL into content consumers want to watch.
And just wait till the NFL reopens its contract with its media partners. That's going to be seismic. Mark Douglas, President and CEO of Mountain.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.